Welcome to the MicroLearning Institute. In this tutorial we will review question number 1, trailer, from the June 2013 ACCA P2 examination paper. In this question we're asked to prepare the group consolidated statement of financial position of trailer as at the 31st of May 20x3. Now the trailer group comprises 3 companies. There's trailer itself, there's Park, and there's Calle. So firstly, let's look at when trailer acquires control of both Park and Calle respectively. And again, we see that even though trailer acquired a 14% interest in Calle on the 1st of June 2011, trailer didn't acquire control of Calle until trailer purchased Park, who already had control of Calle. So trailer acquired control of both Park and Calle on the 1st of June 2012. So now let's look at the group structure. And here we need to allocate a percentage of both Park and Calle to the trailer group. Now Park is quite simple in that trailer acquired 60% of Park, so consequently non-controlling interest own a 40% stake. However, for Calle, we know that trailer initially acquired a 14% interest in Calle as at the 1st of June 2011, and then subsequently acquired 60% of a 70% interest when trailer acquired 60% of Park and Park acquired 70% of Calle. So directly the trailer group owned 14% of Calle, and indirectly the trailer group owned 42% of Calle. So consequently 14 plus 42, so the group owned 56% of Calle, whereas as a balancing figure, non-controlling interest in Calle sat at 44%. Now let's look now at the fair value of the net assets at acquisition. And firstly we look at Park, and it tells us in the question that ordinary share capital, retained earnings and other components of equity were $1210, $650 and $55 million respectively. We're also told that the fair value of net assets was $1,950, so as a balancing figure we can conclude that there needs to be a fair value adjustment, and this fair value adjustment, we're told, relates to non-depreciable land. Now let's look at the fair value of the net assets of Calle at acquisition, and again, as we said, this control was achieved on the 1st of June 2012 when Caller's ordinary share capital, retained earnings and other components of equity were $800, $240 and $70 million respectively. Similarly, we're told that Caller's fair value net assets was $1150 million, and again we can conclude as a balancing figure that we need a fair value adjustment on the group's recognition of Caller's net assets of $40 million, and the question tells us again that this fair value adjustment relates to non-depreciable land. So now we can calculate goodwill in both Park and Calle. So Park fair value consideration was $1,250, and again for that the trailer group acquired a 60% interest in the fair value of the net assets of $1,950. So on acquisition, goodwill in Park was recognized at $80 million. In Calle, Park paid $1,270 for Calle. However, of course, trailer only owns 60% of Park, so trailer only paid 60% of that $1,270. But additionally, trailer also owned 14% of Calle at the acquisition of Calle, and that from IFRS 3 is remeasured to fair value, and in the question we're told that the fair value of the 14% already owned was $280 million. So consequently, the total consideration that the trailer group paid for Calle was $1,042 million. Again, we match this with the share of the net assets. This is 56%, you'll remember from our group structure, of the fair value net assets in Calle at acquisition of $1150, giving us $644, consequently recognizing goodwill in Calle of $398, and of course total goodwill at acquisition of both Park and Calle of $478 million. Next up, let's look at Note 3, which tells us about the impairment in Park. Now, Note 3 says that Goodwill of Park and Caller was impairment tested at the 31st of May 2013, and of course that's the date on which we're preparing the consolidated statement of financial position. We're told there was no impairment relating to Caller, but the recoverable amount of the net assets of Park was $2,088 million. There was no impairment of the net assets of Park before that date, and any impairment loss has been determined to relate to goodwill and property, plant and equipment. So let's look at the carrying amount of Park now in the books of Trailer at the 31st of May 2013. Now we have a statement of financial position for Park, which tells us that ordinary share capital reserves and other components of equity sit at 1210, 930 and 80 respectively. We remember that at acquisition we had to recognise a fair value adjustment. And also we remember that goodwill, which was recognised proportionately, now again we recognised goodwill of 80 on the 60% that we acquired. So consequently, when we scale up this goodwill to reflect the 100%, it's $133.3 million of goodwill. So consequently, the carrying amount of Park in the group accounts at the 31st of May 2013 is $2,388.3 million. Again, the question tells us that the recoverable amount is only $2,088 million, and of course we recall that IAS 36 impairment tells us that we can carry an asset or a cash generating unit at no more than its recoverable amount. So as the recoverable amount is less than the carrying amount, we must recognise impairment with respect to the group of $300.3 million. Now the next question is, how do we allocate this impairment to the net assets and goodwill of the group? So the total impairment is 300.3. So firstly, IAS 36 tells us we allocate against goodwill. Now group goodwill is 80, so we don't have enough goodwill to absorb all of the impairment. Next, we allocate against non-controlling interest goodwill. So the total goodwill is 133.3. We've allocated 80 against the group. Next, we allocate 53.3 against non-controlling interest goodwill. But still, we haven't absorbed the full amount of the impairment. So the remaining amount of impairment, the balancing figure of the total impairment of 300.3 less what's already been allocated to the group and the non-controlling interest, is 167, and this is allocated to property, plant and equipment. Next, let's look at the treatment of Caller. Again, from the 1st of June 2011, when Trailer acquired a 14% interest in Caller, to the 1st of June 2012, when Trailer achieved control of Caller, Caller is a financial asset on the separate books of Trailer. However, from the 1st of the 6th 2012 until the 31st of May 2013, where we're preparing the consolidated statement of financial position, Caller is a financial asset on the separate books of Trailer, and it's under control of the Trailer group. So consequently, we need to eliminate any fair value gains in Caller that have occurred in the separate accounts of Trailer. So the fair value of Caller on the 1st of June X2 was $280 million, and this fair value had increased to 310 on the 31st of May 2013. So the fair value gain of 30 needs to be removed from the consolidated reserves. Otherwise, we're consolidating or adding two gains in Caller, one in the individual entity and two in the group accounts. So again, on consolidation, we remove any gain that occurs in the individual accounts of Trailer with respect to its holding in Caller. Next up, Note 4 tells us about a loan. So Note 4 says that Trailer had made a loan of $50 million to a charitable organisation for the building of new sports facilities. The loan was made on the 1st of June 2012 and is repayable on maturity in 3 years' time. Interest is to be charged 1 year in arrears at 3%, but Trailer assesses that an unsubscribed rate for such a loan would have been 6%. The only accounting entries which have been made for the year ended the 31st of May 2013 are the cash entries for the loan and interest received, which have resulted in a balance of 48.5 million being shown on the financial asset. Now let's look and see how that loan should be accounted for. So again, the loan is accounted for on the statement of financial position at the present value of its future cash flows. And again, those future cash flows are 3% of the 50 million, so a cash flow of 1.5 million in X3, discounted at 6% to a present value of 1.41. In X4, similarly, another cash flow of 1.5, discounted for 2 years at 6%, giving us a present value of 1.34. And on redemption, we have a cash flow of 50, which is the redeemable amount, plus the interest of 150, so totaling 5150, discounted for 3 years at 6%, giving us 43.26. So the total present value of the loan should sit on the statement of financial position at 46.01. Now, in terms of the adjustment, we're told that the loan was initially recognised by Trailer at 50 million. We know that the present value of the loan cash flows at inception was 46.01. So consequently, we must recognise a P&L expense of the difference, $3.99 million. So recognising the loan at its initial amount, we say that on the 1st of June 2012, we recognise the loan at the present value of the future cash flows of $46.01 million. Interest is charged in the year ended the 31st of May X3 at 6% of $46.01 million. That's $2.76 million. The cash flow, again based on 3% of the 50 million, is 1.5, leaving us with a closing balance on the loan of $47.27 million. Next up, let's look at Note 5, which tells us about property, plant and equipment. And this note says that on the 1st of June 2011, Trailer acquired office accommodation at a cost of $90 million with a 30-year estimated useful life. During the year, the property market in the area slumped and the fair value of the accommodation fell to $75 million at the 31st of May 2012, and this was reflected in the financial statements. However, the market recovered unexpectedly quickly due to the announcement of major government investment in the area's transport infrastructure, and on the 31st of May 2013, the valuer advised Trailer that the offices should now be valued at $105 million. Trailer has charged depreciation for the year but has not taken account of the upward valuation of the offices. Trailer uses the revaluation model and records any valuation change when advised to do so. So now let's look at how we account for these transactions in property, plant and equipment. So again, on the 1st of June X1, we recognise property, plant and equipment in line with IAS 16 at $90 million. We depreciate at the $90 million over the useful economic life of 30 years to the 31st of May X2, leaving us with a year-end balance sheet amount of $87 million. The recoverable amount at the 31st of May X2 is only $75 million, so consequently we must recognise an impairment loss to the P&L of the difference between 75 and 87, which of course is $12 million. Again, in the subsequent year to the 31st of May 20X3, we depreciate the 75 million over the remaining useful life of 29 years, recognising a depreciation expense of $2.58 million, leaving us with a closing balance at the 31st of May 20X3 of $72.42 million. However, we're told that the revaluation amount is now $105 million. And of course, as we, Trailer, apply the revaluation model of IAS 16, we can now recognise a total revaluation gain of $32.58 million. So now let's look at how that revaluation gain is recognised. So we reverse the previous impairment loss of 12 million, less of course any depreciation that would have been charged if we had not impaired. And of course we would have depreciated that additional 12 million over the remaining useful life of 29 years, so 0.42 of a million would be depreciation that would have been charged if we hadn't impaired. So consequently, the impairment loss remaining to be reversed is 11.58. The total reversal, as we've seen from the earlier working, is 32.58. So any reversal in excess of 11.58 is recognized as a revaluation gain and recognized in other comprehensive income and in the revaluation reserve. And in our case, that's $21 million. Next up, let's have a look at Note 6, which tells us about a restructuring provision. So we're told that Trailer has announced two major restructuring plans. The first plan is to reduce its capacity by the closure of some of its smaller factories, which have already been identified. This will lead to the redundancy of 500 employees who have all individually been selected and communicated with. The costs of the plan are $9 million in redundancy, $4 million in retraining costs, and $5 million in lease termination costs. The second plan is to reorganize the finance and IT departments over a 1-year period, but it does not commence for 2 years. The plan results in 20% of finance staff losing their jobs during the restructuring. The cost of this plan are $10 million in redundancy costs, $6 million in retraining costs, and $7 million in equipment lease termination costs. No entries have been made yet, so let's look at this provision. So for Plan 1, there's a redundancy, and of course we have an obligation because we've been communicating individually with the selected staff, so we recognize the redundancy as a provision of $9 million. The retraining relates to future periods, so again cannot be classified as a provision. And the lease termination under IAS 37 is classified as an onerous contract and again is recognized as part of the provision. Now for Plan 2, we don't recognize anything as a provision for Plan 2 because it relates to a future period, and as IAS 37 requires a past transaction to have occurred before we can recognize the provision, we are precluded from recognizing Plan 2. So consequently, the total provision to be recognized in the financial statements of Trailer is $14 million. Next we look at Note 7 in relation to a pension. And again, we're told that the fair value of assets and the present value of liabilities on the 1st of June X2 is $28 million and $30 million respectively. We're told that the company made a contribution of $2 million to the fund, which increases the carrying amount of the assets. The benefits that were paid to pensioners reduced the assets of the fund, but also of course reduced the liability to those pensioners. The return on plan assets, again the interest rates are 5% and the assets at opening were $28 million, so the return on plan assets increases the assets of the fund and also is a net reduction in the pension expense to the income statement. The interest, because of course we're moving closer to actually making the payments, again is based on 5%, which is the interest rate of the opening liability of the fund of 150, is recognized also as an expense to P&L, as well as being recognized as increasing the present value of the future liabilities. The service cost of $1 million increases the present value of the liabilities and is also recognized as an expense to P&L. And remeasurements now. There's a remeasurement gain on the assets as a balancing figure to give us a closing fair value assets of $29 million. So the remeasurement gain on assets is 0.6 of a million, and a remeasurement loss as a balancing figure on the present value of liabilities of 5.5 million, giving us a net remeasurement loss or expense of $4.9 million. Now, in relation to IAS 19 pensions, the pension expense to the P&L is netted off for return of plan assets, the net interest and the current service cost, and the remeasurement gain is treated, or the remeasurement loss in our case, is treated as an expense in other comprehensive income. So now that we've worked through all of the adjustments and all of the group adjustments and the unaccounted for issues, we can now begin to prepare the consolidated reserves. So again, starting point for these is to look at the individual company accounts, and again we've been given a balance sheet for each of the entities in the group for the 31st of May 2013, from which we can extract that the individual company reserves for Trailer, Park and Calle are 1240, 930 and 350 respectively. Fair value adjustment, which is recognised at acquisition, in Park was 35 million and in Calle was 40 million. The fair value gain on the investment is removed from the books of Trailer, again because we're going to be consolidating those in the future. The property, plant and equipment impairment of 167 million is again reduces the carrying amount of the reserves in Park from a group perspective. The loan impairment reduces the reserves of trailer. The loan interest income of 2.76 is added back to the reserves of trailer. The reversal of the impairment loss also goes to profit and loss. And the provision for Plan 1 in relation to the restructuring reduces the reserves of trailer. The pension expense, which we'd recognised and calculated, goes to P&L and reduces the reserves of trailer. So updated for all of the group related adjustments and all of the unaccounted for transactions, we've got updated reserves of 1205.25 in trailer, 798 in Park and 390 in Calle. We can now consolidate these reserves. So the reserves of trailer consolidate entirely, and that of course we're preparing the consolidated statement of financial position for the trailer group. And we add to these reserves of trailer the group share of the post-acquisition gain in reserves of each of the other two entities. So again, when we look at Park, the group share of Park is 60%, and the updated reserves figure just calculated is 798, and if we look at the reserves at acquisition of Park, they're 685. So 60% of that movement consolidates 67.8 million in post-acquisition reserves of Park. Similarly with Calle, we'll remember from the group structure that the group share of Calle is 56%. The updated reserves is 390, and the reserves at acquisition at Calle, adjusted for any fair value adjustments, is 280, giving us 61.6 million in updated reserves of Calle. Now, the impairment, of course, of Goodwill is deducted from the carrying amount of reserves because, of course, this impairment expense of 80 million was also deducted from Goodwill on the asset side of the balance sheet, leaving us with consolidated reserves at the 31st of May X3 of $1254.65 million. Next, we can look at non-controlling interest, and again the fair value of the net assets of both Park and Calle can be calculated at the 31st of May X3 from ordinary share capital, updated reserves and other components of equity directly from the statement of financial position. We must, of course, remove from the books of Park the investment in Calle, because of course we will be separately calculating the non-controlling interest share of Calle. So to also include the investment in Calle in the books of Park would effectively double count the non-controlling interest share of the net assets of Calle. So we remove from the books of Park, from the net assets of Park, the investment in C, giving us a fair value net assets in Park and Calle respectively at 818 and 1285 million at the 31st of May X3. Now, of course, the non-controlling interest share, as we've calculated from our group structure, of Park is 40%. 40% of 818 million is 327.2, and of course the non-controlling interest of Calle is 44%, and 44% of 1285 is 565.4. So the total non-controlling interest to be recognised for the statement of financial position is 892.6. Similarly, other components of equity, we can look at the individual accounts of Trailer, Park and Calle. Now we need to make the adjustments to these that reflect the group activity. So the revaluation gain was 21, and of course revaluation gains are recognised in other comprehensive income and other components of equity. The pension remeasurement loss of 4.9 is recognised also in other comprehensive income and other components of equity. So updating these reserves, we get 141.1, 80 and 95 respectively. Similarly to the ordinary reserves, we can now consolidate these. So we consolidate Trailer in its entirety at 141.1, and of course the group share post-acquisition in Park, and again there we have the updated figure in Park of 88, and if we look at the acquisition of Park, the other components of equity was 55, so the group share of that movement is 15, and similarly with Calle, group share is 56%, updated components of equity is 95, and if we look at the acquisition other components of equity, it was 70, giving us a share of 14. So consequently, the consolidated statement of financial position, other components of equity, is $170.1 million. Now finally, we can now compile the statement of financial position. So again, we've got trailer, park and caller all controlled by the trailer group, with some adjustments to give us the consolidated figures. So property, plant and equipment from the individual entities. Now there's a fair value adjustment in P of 35, and of course a fair value adjustment in C of 40 to be taken into account from group perspective, and of course we have impairment of property, plant and equipment of 167, and we also had a revaluation gain of 32.58, giving us a consolidated property, plant and equipment of 3780.58. Also, we have Goodwill, which was initially recognized at 478 and subsequently impaired by 80. So Goodwill consolidates at 398. Financial assets, we had the impairment of the financial asset of 399, and we also had interest, which increased the value of the financial asset of 2.76. So our financial assets consolidate at 480.77. Current assets, simply the sum of the three individual entities at 1726, giving us a total assets figure on the consolidated statement of financial position of 6385.35. So looking at the other side of the statement of financial position, we have ordinary share capital, which of course is only the ordinary share capital of trailer, because we are preparing this consolidated statement of financial position for the shareholders of trailer. Reserves, we've already had a working on reserves where we confirmed that the consolidated reserves were 1254.65. Similarly with other components of equity, we've already done that working at 170.1, and non-controlling interest, moving that value from the working at 892.6. Non-current liabilities, we take into account the individual non-current liabilities, and current liabilities are increased for the provision that had to be recognized in relation to the restructuring, and of course that consolidates at $412 million. So our total liabilities and owner's equity also consolidates as total assets at 6385.35. Thank you very much for watching this tutorial from the MicroLearning Institute in relation to the ACCA P2 June 2013 examination trailer.